Please give us suggestions on trading futures and hedging it, buying a future and hedging it with naked put for a bullish view. This has a defined loss and margin is also less than credit spreads. So I'm not really sure. Why not confirm it? You want a bullish position. So what we will do is we'll buy Bank Nifty futures. So we'll add one future and that is costing you 1,48,000. Now if you want to hedge it, okay, if you want to hedge it completely, you will need to buy a put. Right now Bank Nifty, where is it trading at? 39,200. Now if we go here, 39,200. We bought futures. Now let us select options. We want to buy a put option, 39,200. So we buy at the money put option, and the margin is around 24. Yeah, a little bit less. This is a strategy. I'm just trying to give you an example by establishing a simple strategy of buying futures, hedging it with a put. If you look at it, you will find that this is simply a payoff diagram for a call. Right? Nothing different. So if I buy at the money call, just check what the maximum loss risk is. It's 6,386. If I divide 6,386 by 25, I get 255. Instead of doing this, if I just buy a call, so according to our calculation, it was around 255. Okay. So in fact, you can see here is that the cost is less. It is 5,841. So the cost of strategy is actually less. You still make somewhere similar, returns. Upper break even in this case is 39,433, and in the previous case it is 39,455. Then you would ask a question: why not buy a call straight away and be done with it? Why to establish two different positions and this and that? One strategy that I have seen some of the experienced traders establish, what they would do is they would buy a future, buy a put as a protection, and sell a call, okay, against the futures. So now if I look at the graph, you will see this looks like a bullish debit spread. So buying call, selling call, same thing. So they would do this. So what would happen is if you go lower, the put will protect you. Instead of making the around 6,000 loss, we are making now 3,000 loss. But instead of making unlimited profits, now you are making 2,000 profits. So I mean, what I will tell you is the moment you buy a future and start hedging it with different option combinations, you will end up creating one or the other strategies that we have been monitoring. So it does not make too much of a difference. And I have tried like every possible combination of futures and options, and I have tried all that. Everywhere there will be risk. Everywhere there will be cost associated with reducing the risk. So if you don't want the unlimited risk, then you have to bear some cost. It is not going to change. It is not going to change. And once again, see, the margin required is a little less, but again, our objective is to keep 50% free for adjustments. And if you can't do that, then really, how much difference does it make? So we are also making somewhere around 2,000 rupees, and here also we will make somewhere around 2,000 rupees if the market goes to 39,400. Whereas in our case, market simply has to stay here. It does not have to do anything special for us to make money. I don't think you really require futures. You can achieve similar results or even better results with options. And as regards to defined loss, obviously all our strategies have defined loss. We are never trading a strategy with open-ended loss possibility. So you should stick to options because of the non-linear characteristic that is there. All right. I have already, I think somewhere I have said maybe in the options intensive that the payoff characteristic of a future is linear and that of an option is non-linear. So that non-linearity is the real benefit of trading options, and you can in fact utilize that non-linearity in your favor, and you can create some beautiful strategies, or you can create strategies for any objective that you want to meet.